Good morning, guys. My name is Ali. On this channel, we talk about making money, and this is one of the options that I've been focusing on lately, which is life insurance, whole life and term, and IUL, and many other options that are available, mortgage protection, income protection.
Someone with a 919 area code said.
The video that I found on YouTube is really incredible, and it explains the infinite banking. It's something that's been talked about a lot lately and advertised a lot, and no one has been able to really break it down into bite-sized pieces where you can understand it. But I found this guy Steve on IBC Global, which I actually subscribed to this channel, or not subscribe. I joined his channel. He's he's been doing it for quite a while, and he knows a lot about the insurance industry. So let's listen to some of the stuff he had to say. I'm going to comment as we go.
Which is usually what leads people. A question we get a lot is, how do people use a whole life insurance policy as their own bank? They've heard of the concept, but how does it actually work? Today, we'll talk about exactly that, and at the end of this video, I'll talk about why people do this, and I'll also show you what I do. So let's start with the very beginning, which is usually what leads people to explore using whole life insurance as their own bank. So usually, people work with an actual bank, and they get sick of it. So for example, someone feels like this: hey, I just got a loan from the bank. I feel like I'm going to rip my hair out because everything just takes forever. I'm self-employed. They asked for every piece of financial information that I have 18 times before they finally approved me for a loan that I didn't even like. Ever feel like that? So a lot of times people feel like this when it comes to working with an actual bank. And also, when you look at working with a bank, if I were to get a 30-year mortgage, we just looked at a case like this, where someone was borrowing about $600,000. It was an $800,000 piece of property. They put about $200,000 down, and the loan amount was $600,000. And this is with a lender. The interest rate was just over 7%. I think it came out to 7.125% or something like that. How much do you think they actually paid in interest? Because mortgages can be confusing. What was interesting is on their closing statement, so on their closing statement, their closing sheet, they saw that the total interest they were paying something like 113, or it might have been 130%. I forget the exact amount, but they see that and like, all right, what does that mean? Because I was told I'm paying 7.15% in loan interest. Here's what it means. So they took a loan for $600,000. They saw exactly how much they would pay over the next 30 years. So we've got our total payments, and those total payments came out to, guess how much money? It's a little bit more than this. I'm just going to use round numbers. $1.5 million. We know that the loan principal was how much? The amount they borrowed, $600,000. So if this is you.
Hey guys, are you paying attention to what's going on here? The loan was $600,000 mortgage loan, and the rate of interest was roughly 7%, and total payment's going to be $1.5 million. That's more than double, guys. More than double. I want you to guys stick with me and watch the rest of the video, because it's, let me make this a little bigger so you guys can see me. Hang on. The amount of money that you pay in interest is just it's mind blowing. I can't believe this is actually happening, and people are not aware of that. They buy a house for 100,000 and they end up paying 500,000. So this illustration is really incredible because it breaks it down into little small steps, little bite-sized pieces, so you can comprehend. Because the bankers and the accountant and the people that design these policies or the loans are geniuses at what they do, and we end up getting punished for it. But nobody really knows what's going on coming in and having to take a loan to a mortgage loan to buy a home. Okay, let's watch a little more. This is really, really good, guys. I want you to pay attention and really digest and consume this information and really comprehend what he's saying. He's really good at what he does.
You see, I take this loan out for 600 grand. I pay a total of $1.5 million. How much did I pay in loan interest? Well, it would be the difference, wouldn't it? Which in this example would be $900,000. And these are based on actual numbers that someone just looked at within the past week from the numbers we looked at on their closing sheet. So the first reason people typically don't like working with an actual bank is because they feel like this. And then the second reason is we see that we are paying a lot of interest to the bank. That's where banks are going to make a ton of money, where they make the majority of their money. So this leads people to look for an alternative. And whole life insurance can work very well, which we'll go through exactly how it works. And we'll break it down into 2 steps.
Hey guys, life insurance is the best solution when it comes to taking out loans or putting your money, investing your money. If this is something you're interested in, please comment 1 to the number in the comments or the number on the screen, and I'll reach out today and I'll show you what options are available for you. You have to qualify for it, so as long as you're healthy and you're young, you don't have to be young actually, as long as you're in good health, you'll be able to qualify for these policies. Let's continue on watching. This illustration is really, really powerful, and it's going to put everything in perspective.
Before we look at step 1 though, what is an alternative if you said, I don't want to have to deal with that with a bank, but I'm also not interested in whole life insurance? What's an alternative that I could take? Well, the alternative here would be just to use cash. You ever hear the term cash buyer? So in the example above,
sorry guys, I'm going to interject real quick. As you guys can see, the only way to alleviate that problem is by paying cash, which is nearly impossible. Nobody has $600,000 sitting under their mattress and they can just go out there and just write a check for $600,000. So the only option is available for you is a life insurance, and Steve's going to get into that here in a minute. Please pay attention and take notes. This is very, very powerful information, and it's current too.
we would need to come up with how much cash? Another $600,000. That would prevent the need to have to go through underwriting and feel like this. And it would also prevent me paying $900,000 in interest over 30 years, which no one wants to do. So if I've got the cash, I could write a check for $600,000. It's paid off. I could also, as an alternative, start with the mortgage and then chip away at it quickly. I know some people like to do that. But if I've got the cash, that solves the problem. Now, what if you don't have the cash? What are the options? Well, option A is to save money, to build up cash in the bank account so you can become a cash buyer, or two, sell something if you have valuable assets to try and get more cash, which might not always be a good idea. But to become a cash buyer, we actually need to have the cash, and this involves saving money. So that's the alternate approach. And I mention that because that leads right into how people use a whole life insurance policy. So let's begin with step number one, which is what? Well, it would be funding a policy. I'm going to fund my life insurance policy. Another word for this could be capitalize. What this involves is you putting money into a life insurance policy. You say, I'm interested in this life insurance policy. Here's my dollar. And I'm going to pay this dollar to this life insurance company that I am getting my life insurance policy with. So as you fund the policy, what happens is you build, or the policy builds, what is called cash value. This is it right here. This is how we use a policy as our own bank.
Okay, guys, so what you want to do basically here is purchase a whole life policy that builds a cash value, and you can utilize the cash value to borrow against it to purchase a home. So basically you get the money the same day. It's your money. You don't pay any interest on it, and it's available for you anytime you need it, and you pay yourself back. So the bank is not even involved in this scenario whatsoever. Please continue on watching and try to learn as much as you can. There are people that need my help, and that's why I'm making this video. If you guys need help being financially independent, please reach out. Text 1 to the number on the screen, and I will get back to you immediately. Text 1 to 330-577-3496. Let's continue on watching.
You're going to see it works a lot like a personal line of credit. But staying focused on step 1, funding the policy or capitalizing it, in order to actually build up cash value, I have to put money into the product. I do have a guaranteed minimum interest rate. You'll also see dividends applied to the life insurance policy, but to actually build that value up, just like what I would do if I'm going to become a cash buyer, I've got to save money in the bank. I'm doing the same thing. Instead of saving money in my checking and savings account, I'm saving it in the cash value of my life insurance policy. Make sense? Okay, cool. So step 1, funding the policy. Let's go through the cash value actually and how it works. So we'll call this step 2. That line is not straight. It's going to drive me nuts. That's better. Okay, cool. So step 2, how it works. So the cash value will keep on compounding for me. What does that mean? If you have $100,000 in cash value, let's pretend that it's earning 4%. And if you just let it sit and grow, it'll continue to earn 4% every year. But you say, I want to be able to use this for a piece of property. You say, I see a piece of property and I need $50,000 to buy in. So you can access $50,000 from your life insurance policy. The maximum amount that you can borrow against a life insurance policy is whatever you have in cash value. Let's say that the interest rate is 5%, higher than what I'm earning on the policy. We did that on purpose here. Okay, so that 5% would go to who? The insurance company. What's 5% of $50,000? $2,500. So we do pay them interest. Now, that 4%, if you never touched the policy, if you never touched the cash value, you would get that 4% on the 100 grand. That's what the insurance company gives to you, which is $4,000. Here's how it works. Even though you've accessed that $50,000, you're still getting the 4% growth rate in this example on the full $100,000. So your money stays at work for you the whole time. That is a big reason why people do this. Now, if that doesn't make sense, here's an example that helps a lot of people, including myself. Let's say you have a piece of real estate and the fair market value appreciates by 4% every single year like clockwork. You say, I've got this equity in my real estate. I want to take a loan for $50,000.
Hey guys, I want to mention something important. Like Steve just said a few seconds ago, you can only borrow from your life insurance what you have in cash value, what you built in cash value. So, like, say in 7 years, let's say, for example, let me pull up a calculator here and let's go through a simple scenario, okay? Let me pull this up. There you go. Say if you're paying $1,000 a year, okay? Just even number, okay? So you're paying $1,000. Excuse me. Say you're paying $1,000. Multiply that by 12, right? I'm sorry, not by 12. I'm wrong on this. So you're paying $1,000 a year. That's already 12 months. If you multiply that by 7 years, sorry about that. Let me clear that again. 1,000 times, roughly your cash value start building around year 7, because year 1 and year 2, you're paying some fees into the policy, and as the years go on, you'll start building with your compound interest. If you're at 5%, 4%, whatever the insurance carrier is, they're going to give you your interest rate. So by building compound interest in, let's say, 7 years, which is $7,000, you got $7,000, right? I'm just using generic numbers here, okay? In 7 years, you paid in $7,000. So year 7, you may have, I don't know, $8,000 or $9,000. So if you decide to borrow at year 7, you'll be able to borrow you'll be able to borrow $8,000 or $9,000, whatever accumulation you have in your cash value. I hope that makes sense. If you guys have any questions, please leave them in the comment below, and I'll be more than happy to answer them for you. Let's continue on watching and see what the illustration looks like.
To take that $50,000 loan, the bank is going to charge me, let's say, 5% interest, which would be $2,500. That goes to the bank. Now, when you take that $50,000 loan, what happens with the 4% depreciation on the real estate? Do you only get it on the remaining equity? No, you still get it on the entire property value. All of your real estate keeps on appreciating in value every year. That's how the cash value in a whole life insurance policy works. It keeps on compounding as time passes. So, why people do this? We're going to look at an example. I'm also going to talk about the most important piece when we go through why people do this, but there's 2 main reasons why people use whole life insurance as their own bank instead of working with an actual bank or just saving money in cash. The first reason number 1, is control. There's a lot more control that you have as a policyholder compared to what you would have if you get a loan from a bank. And then number 2, is another C, compounding. Your money keeps on compounding for you even when you access the money. So to illustrate this, I just want to hit this point and drill it home.
That's a very strong point here, guys. I want you to understand this. When you take out, let me make this a little bigger so you guys can see me. When you take out a loan out of a life policy, like say you take out a $100,000 loan out of the policy, your $100,000 still gonna, even though you made a withdrawal, not a withdrawal, you took out a loan, your $100,000 still accumulating compound interest even though you took out a loan, which is really, really nice. So the money's still going to act like it's there even though you took it out. What happened, the way the life insurance work, when you take out a loan, if your life insurance policy is $500,000 and you took out 100,000 in loan, what they do, they deduct it from the death benefit. So now your death benefit, instead of being 500,000, it's actually 400,000. So you're borrowing against your cash value, and your cash value is going to continue on accruing interest, accumulating interest. But what happened is they deduct your in the event of death or sickness, or you have to use your living benefits, they deduct the 100,000 from the loan. I hope that makes sense. Again, if you guys have any questions, leave them below. If you want me to start a policy, if you're interested in starting a life insurance policy with me, I need to ask you a few health questions, and the healthier you are, the better rates you're going to get. And the younger you are, the better rates you're going to be able to lock in. All right, let's continue on watching. I hope this helps, guys. Let me know if you have any questions. Leave them in the comment below. Thank you.
If you have $100,000 today, and in 20 years, that's going to be worth $500,000. Sound like a good deal? Probably. Maybe you add money, maybe you don't. Let's just pretend in 20 years it's going to grow to $500,000. That's if you let it sit and grow. So you can't touch that money right now. However, what if I told you as this grows, so 5 years it'll be worth 180, then by year 10 it'll be worth 250, it's just going to keep on growing. As it grows, you can use this money and you'll keep earning the same interest, and any money that you use, as long as you put it back by year 20, you're still going to have $500,000, meaning it's going to keep on growing year in and year out, regardless if you just let it sit and grow or if you decide to pull the money out and use it. You keep on getting that compounding. Sound like a good deal? Yes. That's why people are interested in it. Now, if I'm going to use it.
Just real quick, guys. Even though you take that money out, it's still going to act like the money's still there, and it's still going to continue on building a compound interest. This is a very, very powerful point. I want you guys to understand what that means. And if you have any questions, again, please leave them in the comment below.
In a life insurance policy or take a loan from a bank, I'm going to have loan interest and we'll account for that. Let's look at an example and then I will go over exactly what I do. So, example, we're going to look at a case study to demonstrate this. This will be we'll have some fun with this. So we've got a 45-year-old individual. He is going to fund a policy for a short period of time, $100K per year. For 5 years. It's a total of $500,000, which is just money sitting in cash right now. He says, okay, I'm interested in learning more about this. Show me how it works. However, after I get the $500K in, I'd prefer to have to never make premium payments again. 100% with you, no problem. What he wants to do is buy a $300,000 property. The loan interest rate with his life insurance policy is a little bit more than 5.56%. Side note, rates are actually a little bit lower than this right now. You can even find fixed rates with policies less than 5%. Just a side note there. But what he's mainly interested in is using the policy as his own bank, and he's going to pay it back over 8 years. So we're going to look at that, and we're also going to look at the benefit to the insurance company, because how does it actually work for them? It is always helpful to see how things work from the other individuals, or in this case, the other institution's financial position. So, step number 1, looking at his actual life insurance policy. This right here, in my opinion, is the most important piece, because when people have buyer's remorse about this, it's never about the cost to borrow, how the loans work, none of that stuff. It's was the cash value set up for as much cash value as possible. He pays $100,000 in. First year, he's at 92%. His break-even point, just about year 4. He's paid in $400,000.
Hey guys, I want to explain one point over here. If you guys look at the payment over here, the client paid $100,000 the first year, and his cash value is only $92,000, right? But you need to keep in mind you have a death benefit of $1.8 million. So in the event you get sick or you die or you get into an accident, that money is available for you today. So keep that in mind. Even though your cash value is low, don't forget that death benefit is available for you right here, $1.8 million.
He's got just about 400,000. 399 by the fifth year, he's positive. When people complain about whole life insurance or express the things that they do not like, what it is every single time is low cash value up front, and it takes me something like 7, 10, or 15 years just to break even and get my money back. Like, that's it. How you prevent that is by making sure that the policy is set up with the minimum insurance premium and the cash value is maximized. We've got other videos that go through that, but that's always.
I want to explain something real quick for you guys. This life policy is it's designed to build cash value fast. Normal life policies don't work that way. So what happened is, since you're focusing on the cash value, which is this section over here, let me move this up just a little bit so you can move out of the way.
Step number.
Okay, so what happened over here, you see the cash value here, is this particular policy is designed to grow the cash value very fast. If you're not concerned about the cash value, you're only concerned about your death benefit, you can have a lower cash value with the higher death benefit. So basically, if you're this is called what's it called? I can't think of the word right now, but it doesn't matter. But with the point that I'm trying to illustrate over here, life policies can be designed to have high cash value or high death benefit. Like if you look at term life policies, it's cookie cutter. You pay $100 a month, you'll have $1 million policy. $100, but there's no cash value on a term life policy. This is what Steve is illustrating right now. This is a whole life policy, which allows you to accumulate cash value. All right, let's go back to the video.
One. So there's the policy. We see after the funding period, year 6, it's worth $535. Age 58, it's worth about $755. Okay. We're going to compare what we just looked at with loans. Looks like a lot. I'm going to walk you through this. Okay. So at age 50, he takes a $300,000 loan. The impact on his policy is as follows. On the left, you've got no loans. On the right, you've got loans. You took that $300,000 loan. There's your cash value. There's your death benefit. What happened to your death benefit? It dropped by the amount that you borrowed against your policy. What happened to your cash value? It dropped. By how much? A little bit more. It was $535. Now it's $218. That's a bit more than $300,000. What's going on here? Well, it dropped by the $300K loan. And also in this illustration, the insurance company is accounting for the loan interest the next year of the $16,000 and change. That's why we see that reduction for a little bit more. But when you borrow against the policy, here's the two things to be aware of. The life insurance company is going to collateralize the death benefit dollar for dollar. And then the cash value is your line of credit. That's how much equity you have access to. So that will drop when you take policy loans. However, you're still going to earn dividends and interest on the full cash value, as if you never touched it in the first place. Let's demonstrate that. So we'll continue on here. We repay it at $50K per year. To the right, in purple, you see how much of your 50 is applied toward the principal, and then in red, you see how much is applied to the loan interest. So he's paying a net of $50K per year toward the loan at this point in time. He pays nothing toward the premium anymore. He doesn't want to because he wants to be able to focus on loans. That's why he wanted it this way. And he pays a net of $50K per year. So he pays it back, and there's his cash value and death benefit when the loan is repaid. What do you notice here? They're exactly the same. So at age 58, if he just let it sit and grow, we saw before that his cash value would be worth $755, and his death benefit would be worth $1.8 million. In this example, when he borrowed and repaid, there's the last payment, his cash value is 100% restored to what it would have been as if I never touched it in the first place. Control, and then compounding.
Hey guys, I want to mention something. So this client got his policy, he paid $100,000 for 5 years, and at year number 10, I believe this is that what that is? I believe it, year number 10. But anyway, look at this. So his $500,000 that he paid into the into the policy, his monthly premium, his monthly payment, he paid $500 only. Look, he's got $750,000. That's cash he could use, available for him. And his face value, which is also known as the death benefit, is $1.8 million. So there's nothing in the market out there that will give you that kind of. Let me move Steve out of the way for a second. It doesn't matter. Your cash value grew in only 10 years. You made $250,000 or more, almost 260, whatever you want to call it here. So you make $250,000 in 10 years, and you also have $1.8 million in death benefit. If you die or if you get sick or anything happened to you, accident, that money is available immediately. If you need cash to use anytime you want, you can take this money out immediately. So it's a win-win situation. I hope I made myself clear, guys. Let's continue on watching.
That's why he's attracted to it. Control, in the sense that he can pay it back however and whenever he wants. Compounding, the money keeps on moving over time. Okay, so before we wrap up, very, very important to look at this. What's my actual cost to borrow? Two things we want to look at. What your money is growing by. So this is what you're getting from the insurance company every year. And then we've got the total amount. And then what am I paying to the insurance company in loan interest? Here's what I'm paying to them each year. Here's the total amount I've paid to them. And then compare them side by side. So at year 7, which is where the annual loan interest will be the highest, what you got in growth, what you earned that year, was about $24,000. What you paid that year was $16,000 and change. In the black or in the red? I'm in the black. I've received more than what I paid. Now we can make this look negative too. How about the total interest over time? So this isn't year to year. This is looking at the totals. Year 15, total growth, 288. Where that number comes from is if we look at the 15th year, you paid a total of $500,000. At the 15th year, your cash value was worth $788,276. The difference is the gain. That's that 288,276, which matches that number. See where we got that from? It's the total earnings over time. And then, same thing here, we looked at how much you paid in loan interest every year. This is going to tally it up. By the 15th year, $75,000 and change. So in this particular case, you're not in the red. You've received more than what you've paid to the insurance company. So it's a demonstration of how policy loans work and how people actually use these policies as their own bank. To summarize or simplify, they're funding the policy, they're building up that cash value, and then they're using it for opportunities. Because if I know it's going to get typically between 4 to 5% over time, and I can put it to work, so I can get real estate that I'm earning maybe a net return of 8% on. Now I'm getting the earnings in the policy, and I'm putting it to work outside of the policy. We've got to account for the loan interest too, like we just did in that example. So lastly, how I do this. What do I do? Important to put the word what there. What do I do? No, I'm going to show you exactly what I do. Firstly, my policies are with one of the 4 major mutual companies. I set it up to be very, very flexible. So the 4 major mutuals are Mass Mutual, Guardian, New York Life, and Northwestern Mutual. The main reason why is because from everything I've always seen, real policies that have lived the test of time, I see that there's the least chance of buyer's remorse with those policies when it comes to the cash value growth. It's also who we used when we were putting policies together for corporations when I worked at the executive benefits planning firm. So that's why I like the 4 major mutual companies. And then I also set it up to be very, very flexible. So I've got more than one policy, but just to give you an example, these are not my actual policy numbers here, but with step 1 on the funding, if I want to be able to pay up to $100,000 per year so I can really capitalize the policy, what I'll do is not set it up where I'm billed for $100,000 per year. I don't even want it set up where I'm billed for $30,000 or $40,000 per year. What's the minimum? And I set the minimum because the minimum is what hurts the first year cash value. I set the minimum as low as the insurance company will allow. Typically 10% or very close to it with those top companies. So it's $10,000 per year. That's what I'm billed for. And then at my discretion, I add more money to what is called my PUA rider, which I can just log onto my online portal and throw money in up to another $90,000 per year. 10 plus 90 gives me a total of $100,000. Not the actual numbers that I have on my policies.
Hey guys, I want to explain one point that Steve just mentioned over here. So this client wants to contribute $100,000. The cash contribution, annual contribution is $100,000, but he's only obligated to 10% of that, which is he's only obligated to put in $10,000 a year, okay? And he can log in on the online portal, whether it's on your app or your computer or whatever, and you can add in the additional up to $90,000 every year whenever you feel like it. So you're only obligated for $10,000, but the less money you put in here, the slower your cash value growth is. The more money you put in, the faster your compounding interest is going to happen in the cash value. I hope that makes sense. Again, if you guys have any questions, please leave them in the comment below. I know there's people out there that need my help, and that's why I'm doing these videos. All I have to do is ask you a couple health questions, and I can get you started today. Fill out the form that I have below, or text number 1 to 330-577-3496, and I will get back with you immediately. This is a free call just to let you know what you qualify for, and the younger you are, the healthier you are, the better rates you can lock in. Let's continue on watching.
But that's how they're set up, with those same ratios for consistency there. So step 1, I set it up where it's very, very flexible so I can fund it how I want to fund it, as opposed to the insurance company saying, here's a bill you have to pay every year. And then step 2, when I use it, here's how I'll use it. Take loans. Usually takes about 3 business days, from when I request it until the time it actually hits my bank account via direct deposit. And then with paying them, I do pay my loans back. When I'm retired, I might not, because I'll just use them to take income, but that won't be for a very long time, unless I look like I'm near retirement. Hopefully I don't look that old to you, but if I do, that's okay. Here's how I usually like to pay it back. I'll pay interest only when I'm billed for it. So it's not interest only. I'll pay interest when I'm billed, which you're billed one time per year on your policy anniversary date. And then at my discretion, I'll make loan payments. And how I do that is by logging onto the online portal and throwing money at the balance when I want to do that. And if I
Hey guys, I want to talk about this point. This is very, very important. I want you to listen to me. So now when you take out a loan out of your policy, you are not obligated to pay this loan back. So what happened is, if your policy has $1.8 million in death benefit or face value, your loan is deducted from the death benefit. So you're not obligated to put the money back to pay the loan back. But it is better for you to put the loan back into the policy. Just pretend like you're going to the bank and you're borrowing $300,000. You have to make these monthly payment back to the bank, right? Here it's the same situation. You're borrowing from yourself, and by putting the money back into the policy, you're continuing to build that compound interest. So it's more beneficial to you. You're not paying anybody back. You're paying yourself back. So and when you have a life policy, it makes a lot more sense than having to give the money to your bank. Okay? Please leave your comments below. I hope this makes sense.
throw money at the balance, what'll happen is when my next policy anniversary date rolls around, if there's any loan balance remaining, I'm billed interest on that balance for whatever the next year will be. So I hope that made sense, but that's a quick overview of what I do and how I use my policies like a financing tool. Call it as your own bank. Now, there's a lot of different names and concepts for this. You'll hear of infinite banking. There's the book Becoming Your Own Banker. Nelson Nash really started by branding the concept and bringing awareness to it, which is really, really cool. Then you've got Bank on Yourself by Pamela Yellen. I believe she did work with that group at one point in time, but broke off and did her own thing. Same concept, using a policy like your own bank or own financing tool, just branded a little bit differently. And then there's a million other names too. Cash flow banking, and I can go on and on. They're all very, very similar, where I am using a whole life insurance policy, I'm funding it for the cash value where that's maximized, and then I'm using it mainly because I get the compounding, but the control is really, really sweet too, because once I get that cash value big enough, I don't have to deal with banks and institutions anymore. So with that,
Hey guys, that's a very key point that Steve just made. Before you start utilizing your cash value in your life policy, you really need to build it up to the point where you can, where it's worth borrowing from. Basically, at year 7, year 10, year 15, if you put in a $500,000, for example, based on this illustration, at year 10, you have gained $250,000, so you have $250,000 to work with, added on top of your contribution. So you paid $500,000 at year 10. You have $750,000. So that's when you can start utilizing cash value. You can borrow $750,000 from your policy, and it will still continue on accumulating compound interest, and you can pay the loan if you want to. If you don't want to pay the loan, you don't have to. What happened is it gets deducted from the death benefits. I hope that makes sense. Guys, please reach out to me. I'll be more than happy to help you. This is a completely free call. Either fill out the form that I have in the comments below, or text 1 to 577-3496, and I will get back with you immediately. Thank you. Let's continue on watching. There's only a couple seconds left.
that said, I hope you enjoyed this video. This is something I do have a lot of fun talking about. Please let us know your thoughts, and if
I guess that's the end of the video. I hope you guys enjoyed today's illustration or demonstration of how you can use your life insurance, your whole life insurance policy to utilize the infinite banking, which means you just borrow from yourself and you never lose a single dime. I don't know if you guys remember when he first started the demonstration over here. I want you guys to remember this part. It's really, really important. This individual borrows $600,000. Total payment is $1.5 million. That's totally insane. He can completely wipe that number. You can literally just borrow from your life insurance policy $600,000 and pay back $600,000. So if you buy a house for $600,000, you're only paying $600,000 for that house. So the bankers, you're not being screwed by the bankers, and you're not paying this triple, almost, I don't know. I mean, what do we got here? I mean, it's definitely more than double. You got 600,000, that's 1.2 million. These guys are charging you 1.5 million. So if you look at these numbers, it's very unattractive. You think you're actually making money and it's a great investment, but if you crunch the numbers, you're actually not making any money. The bank is making all the money. They're giving you 600,000, but they're charging you 1.5 million. But by utilizing a whole life policy, you can actually take that loan out for free. You can take out a loan for $600,000 and pay back $600,000. So if you purchase a home for $600,000, you actually paid that amount for it. So say if your cash flow from that home is $3,000 a month, you're actually making $3,000 net profit on this. Okay, beside your repairs and all that stuff. But in this situation over here, when you borrow from the bank $600,000, you pay them back 1.5 million, you're actually in the negative. You're upside down. Does that make sense? Okay, guys, please reach out to me if you want to hear some more, and I'll give you some whatever options are available for you. This is 100% free. Call me, text me. I'm going to leave a form in the comments below. Fill it out, and I will reach out to you immediately. Thank you so much for your time, and I hope you enjoyed today's video. Let me make this photo a little bigger. I mean, oh, there we go. I hope you guys enjoyed today's video. Please reach out for additional information if you have any questions, and I'll be more than happy to answer them for you. Have a wonderful day, and I'll look forward to talking to you soon. Bye-bye, and best of luck.